HDFC is one of the three largest financial institutions in India. When a bank of this scale fluctuates, the stability of the entire market is at stake. Over the last 6 months, the glass has cracked. Market panic has erased thousands of crores in investor wealth. The pressure is now moving offshore. 3 major U.S. law firms have launched investigations into potential securities violations, targeting HDFC on behalf of investors holding its American depository shares. If you are holding HDFC stock or looking at the current dip, you need to decide if this is a PR nightmare creating a discount or the early evidence of a systemic governance problem. This chart tracks HDFC's stock price over the last 6 months. We can trace the drop back to 2 specific internal failures. The first break occurred on March 18th. Chairman Atanu Chakrabarty resigned, citing practices at the bank that conflicted with his personal ethics. The stock fell 5% immediately. Then, on May 27th, a report detailed alleged camouflaged payments within the bank's records. The market responded with another 4% drop. This sequence of events pushed the share price to a multi-year low, bottoming out in the 748 rupee range. That price point has created a divide. Existing shareholders are waiting for a rebound, while value investors are weighing the risks of a blue-chip stock trading at this level. The current market valuation reflects more than just a loss of capital. It is pricing in a sudden loss of institutional trust. The U.S. investigations focus on a 45 crore rupee anomaly involving the Maharashtra State Road Development Corporation, or MSRDC. HDFC wanted to secure 25,000 crore rupees in deposits. To win that contract, the bank reportedly promised an inflated 6.01% interest rate, which bypassed RBI limits on rate hikes. Allegedly, bypassing standard accounting, HDFC diverted a 45 crore rupee interest payout into its marketing budget, labeling it a road safety drive. They then generated multiple invoices for a single event, routing the funds directly to MSRDC vendors. Ultimately, MSRDC provided only a few thousand crores in deposits, leaving the bank with the regulatory risk for a deal that failed to meet its targets. This specific internal maneuver has now resulted in 3 separate major legal investigations under U.S. federal securities laws. For a bank of this size, 45 crore is a rounding error, but the decision to hide that payment leaves the bank vulnerable to federal litigation in the United States. Internal records suggest the payout was approved in the presence of the bank's top leadership. When the bank eventually took disciplinary action, it issued warnings and a penalty of 1 lakh rupees to the executives involved. To international regulators, a 1 lakh rupee fine for a 45 crore governance failure indicates a weak internal culture. It suggests the bank is not treating these breaches with the necessary gravity. This governance friction is appearing just as the bank's operational health shows signs of strain. Profit growth has slowed to 5%. The metric that matters most here is the net interest margin. NIM represents the difference between what a bank earns on loans and what it pays on deposits. It is the primary engine of bank profitability. HDFC's net interest margin is compressing. As the chart shows, it has now dropped to 3.22%. The Reserve Bank of India currently maintains that its review found no material concerns regarding governance at HDFC. Investors buying the current dip are taking on a business with compressed profitability and a multi-year legal battle on the horizon. Making a decision now requires looking past the headlines and mapping out your specific financial exposure. If you are a retail depositor with a savings account or a fixed deposit, a discrepancy in the marketing budget does not threaten the liquidity of a bank this large. Your capital remains safe. You don't need to take any action. If you are a short-term trader or a shareholder with a low tolerance for risk, the combination of U.S. legal probes and slowing margins makes this a difficult hold for short-term gains. You may want to compare this position against competitors with stable growth profiles. Finally, for prospective long-term investors, looking at the multi-year low price, you are buying at a discount, but you must be prepared to weather the headlines and a slow margin recovery for the next 1 to 3 years. Base your decisions on your personal time horizon and your ability to absorb risk, rather than the immediate market reaction to these governance concerns.